Hello everyone, this is the trading team at Trade Oxygen here. Welcome to another pre-market analysis. So this is Thursday the 3rd of October 2024 and this is for the micro E-mini NASDAQ index futures. So let's see how things are going to play. So looking at the economic calendar, we can see today at 8:30 New York time. So now it's almost 9 a.m. New York time. Half an hour before, we can see there's high impact news being released. So we can expect volatility in the market. And at 10 o'clock, in another 1 hour's time, there is another high impact news. So we can also expect market to be highly volatile today due to this high impact news, which is good for trading, but we have to carefully look into those times to see if if because a huge volatility can disrupt our trading as well. So you have to be a bit careful, but it's good having news. Okay, so looking at the daily chart, we can see the price kind of like if we consider this price leg over here after the gap, we can see the price kind of retraced and up to here. Now the question is whether the price is going to go down or going to go up, right? Okay, so let's look into that. So the daily bias question for the daily bias is the price going to go up or down from here? So looking at this daily chart, it's not 100% clear what the price would like to do, because there's a chance of price going up and clearing this liquidity, or the chance of price going down. So the daily bias is not 100% clear. So in that situation, what we do is we will go down to a low level chart, like let's say 4-hour chart, and see how the 4-hour chart is looking. Okay, so looking at the 4-hour chart, if you look at this price swing, because this price swing from here to here, this price swing, okay, this price swing, what you see basically took this swing high, so took the liquidity, so it broke the price up above this swing high. So this price leg is a bit strong price leg. Now when you look into that price leg, and if I expand that, so because it's a strong price leg, price move, if you look into that, and we can see it reached the daily fair value gap, so we can expect it to retrace down like this, and then the price started coming up. It made some relatively equal high here in the 4-hour chart, but after that you can see the price broke up. So you can consider this as a swing leg after the price being in a range here. And then you can see, if you look, like you can break it into parts if you want. One could say, okay, the price came down here. If you want to analyze it that way, yes, in that case, excuse me. So you can see there is, from this swing low, when the price came here, the price broke down. So in that case, you can consider it as a market structure shift, or like say a break of structure down because of this candle. So if that is the case, and because it came powerfully down, one possibility is in the 4-hour chart at the price currently to be bearish because it took this swing low down, right? So that is one possibility. You can also look into this, that the same thing, that same thing. If I draw it, you can think, because this is the price leg which, okay, after making the relative equal highs here, this price swing from here, you can see this swing low is the one what really broke this swing highs over here. So if that is the case, if you think that, then you can see that swing low is broken here from this candle, from this bearish candle. So that swing leg up starting from here, if it's broken, then that is also like a market structure shift down or break of market structure again down, right? So both of them, what it tells us as a bias is, in the forward chart currently the bias is bearish, right? That is what it tells us. So we understand the most recent price action in the forward chart is bearish due to this break of structures what I explained. If that is the case, then if you are to take trades based on the higher level bias, here the higher level bias I'm referring is 4 hours, because the 1 hour because the daily is not 100% clear. So the 4-hour bias is bearish. In that case, most likely we should take trades bearish, because the most recent high level bias we have, which is the 4-hour, ideally it should be the daily, but because daily is unclear, when I come to 4-hour, 4-hour says to us which is bearish at the moment, right? At the moment. However, one could say the price leg from here to here, overall it's bullish, right? So if I just draw that as well. So overall it's bullish, but that bullish trade, you can see this swing low, if you compare what I said, this swing low here is broken, or you can say this swing low is broken. In that case, what I'm telling is most recent for price action is bearish. Okay, so if the most recent for price action is bearish, then as a trade, the if the price plays that role, the most in the 4-hour, the most ideal trade would be for us to let the price come to the fair value gap, and then for the price to go down, and for us to take a trade here, like I'm giving hypothetically a short entry, hypothetically, like when once the price reach here, hypothetically take a trade entry. Now, are we telling that this is the trade we are going to take? Well, this is one of the scenarios. Keep in mind, price can do whatever price wants. So that's what we have to keep in mind. But if price plays this scenario, then we will be looking for a trade at this point. However, for that the price should play this role. Okay, that is scenario number 1. So now I'm in the 1-hour chart. You can see over here 1-hour chart. It's the same price action, but you can see more candles. However, the same idea what we draw here. Look at my mouse. So if I just show you, so the most recent price action being down, so what we said in the 4-hour is, if the price comes, okay, to this fair value gap over here, then we will be considering taking a trade down. Now to support that, we can see some relatively equal highs here from here to here. So when you got relatively equals high like that, okay, so what it tells us is there is buy side liquidity. Okay, so what that tells us is there is buy side liquidity over here, 1-hour buy side liquidity. Okay, so when you got buy side liquidity just below a fair value gap like this, there's a chance of price, okay, there's a chance of the price coming and sweeping that liquidity. So price is like a magnet. Price works like a magnet. Price goes from, now this swing leg down in the 1-hour. If you look that swing leg from here to here, the price is below Fibonacci Fib 50. That means price is at a discount. So the price would like to move from a discount to a premium. The premium is above 50% Fib over here. Okay, so if you draw the Fib, you will see this is the Fib 50. So price would love to come above 50 into premium 62 to 70 Fib retracement. Okay, so looking at that Fib as well, and then looking at this, price is like a magnet. Price likes to move from premium to, sorry, this is discount to premium. Also, price is like a magnet. Price likes to attract for liquidity. So there's buy side liquidity here. So the price like to come and grab the buy side liquidity. That's how price works. And then price like to come and fill imbalance, which is a fair value gap here. So then again, that also hints the price would love to come to this. Okay. So if you are not sure about what I said now, like liquidity, imbalance, premium to discount, don't worry. Subscribe to the channel and click on the bell icon. We'll release more videos explaining each and every topic. Right. Okay. So that tells us that there's a chance of price moving here. So in that case, if there's a chance of price moving from here to here, so one could look into two different trade entries here. Now the first one is what we said in the 4 hour is to take a sell entry. To take a sell entry when after the price reach here. But for that, we have to wait till the price is here at the moment. We have to wait till the price come all like up here into the fair value gap. And if the price come here, then we can take a sell entry. That is one possibility. But remember, this is not investment advice. This is not license investment. This is only for educational purposes. So we have to mention that due to government requirements and compliance disclaimers. Okay, so this is only for education purposes. So one trade is possible over here. Then it will be a sell entry. Then that goes with 4 hour bias. Most recent 4 hour bias. So it increases the probability high. The second trade is a very quick short trade from over here to here, expecting the price to go and clear the liquidity. Then you go and clear. But in that case, it will be a counter trend trade. Okay, so if I just show it to you, basically what I'm telling is the second option possibility is take a long trade at 9:30 when the market starts. Now it's 9:10. There's 20 more minutes. When the market starts in 20 minutes time, to see if there will be any trade taking from like a long entry from here to here, right? And now we are giving hypothetical scenarios because this is how we look at the market, right? But if you take this second trade, it's counter trend to compared to the 4 hour bias, because we said 4 hour bias is the 4 hour bias is bearish. We explained it a little while ago. So if you take this trade, the chances are the chance is it can be also high. There's a slightly higher chance of it being a losing trade. You have to be very careful because it's counter trend for 4 hour. If you take that, you have to take a quick entry. Now, which one? If you ask, okay, there's two possibilities. Which one is the better trade? Well, number one, if you go with the bias of the higher level charts, it's better. In that case, for our most recent bias is bearish. So in that case, it would be better to take this trade, this one. However, this also is a possibility. Now, which one will work today? Now, this is the pre-market analysis. The market will start in another 10 minutes. Which one will work? Answer is, if you ask from me right now, which one will work? The answer is this. The price can do whatever the price wants. Now, you have to keep that in mind. The price is here at the moment. Let me draw it. Excuse me. The price is here. When the market start, if the price wants, the price can go here. Scenario 1, right? In that case, we can take the second entry. But if the price goes here, then after price comes here, we can take the first entry, the bearish entry, right? So 9:30 when market start, we can take the bullish entry if you want, or we can wait for the price to come here and take the bearish entry. Now, which one will work? Again, I'm repeating that we have to wait till the market start and see what the market wants to do, what the algorithm wants to do. This is just a this is just a possibility, two possibilities, but the price can do something like this. Without any of these, when the market starts, price can straight away, after a while, maybe go halfway somewhere here, and price might even go down. That's another possibility. So we have to be open for these possibilities. Then what we have to do as traders is, when the market starts at 9:30, to see a footprint to see which one of these will work. For example, when the market starts, if there's a huge displacement towards the upside, let's say like towards this side, when the market starts, it's a huge displacement, and if it takes some sell side liquidity before that and a huge displacement, in that case we may go and look for a buy entry, which is what we mentioned here. But for that we have to wait for the price to see whether it gives that footprint with a order block. If it doesn't give that, it might slowly, without giving that footprint, we may not take the trade. Still the price may go up. In that case, what we see is we are checking if there's a footprint over here when the price reach the the fair value gap. If we see something like the price reaching the fair value gap, and then if we see a huge displacement down, then if that displacement make a fair value gap and an order block, in that case, if we see the footprint here for a sell entry, we will take the sell entry. So what I'm telling is, as traders, we have to reflect to what the market gives to us. The market footprint is what we have to reflect. Okay, so this is we are looking at possibilities, and we are trying to make a decision based on probability to see if what entry would help us or work for us. Okay, let's look into the next. Then there's a third possibility as well. We can see in there's a SMT divergence. The top one is the Dow Jones. We can see from here to here, it has made a lower high, whereas if you look at if you look at, let me delete this line. So there is a lower high, whereas there's a, if you look here, a lower high here in the Dow Jones, but you can see a higher high in the NASDAQ. So when this happens, this is a SMT divergence, but we can see some wicks here, wicks here, wicks here, and then we can see the price is starting to go down. What that tells us in the 15-minute chart is there's SMT divergence, which is bearish SMT divergence. What that tells us is, at this moment, there's a possibility of taking a bearish entry as well. What is that entry? Let's go and have a look. So according to SMT divergence, which is here, you can see, but this is a very, very short entry if you have to take it, but it has already gone down now. See, based on the SMT divergence, you can see from here, okay, from here you can take a trade down. Why? Because there's a SMT divergence, as I showed to you. But that's a very, very quick trade. So if you take that trade here, then your target will be a very quick target, which will be the loss of the London, which is this, because there is liquidity, sell side liquidity. So if you sell here, you have to target this sell side liquidity to take profits. So if you ask from me, if we sell here, why are we targeting the sell side liquidity here? If you are not clear, don't worry. Subscribe to the channel, click the bell icon. We'll release some short videos explaining the theory behind that as well. For now, we want you to understand the overall market. So this is a possibility, but the thing is, usually we wait till 9:30 to take a trade. 9:30 is the New York Stock Exchange opening time. Now the time is 9, you can see 9:18. So there's 12 more minutes. 12 more minutes. So, but at 8:30 we can see it causes SMT divergence, giving a possibility of a bearish entry, and you can see it works. It has worked to a certain extent. But if you ask, did we take a trade here? Answer is no. Why? Because we wait till 9:30 market open to take a trade, right? In index futures. But one could take a quick scalp here. If you are a scalper, you could have taken a quick scalp and take some quick points away, quick profit here, right? That possibility was there. So what we at the traders team at Trade Oxygen here, what we look is, we look for high probability entries, and our entries are based on sound logic, which is what we explain here. So we are waiting till 9:30 market open, so we skip this trade, but that was a possibility. Okay, so those are the possibilities we see here in the market. Let's have a look at the main chart again. Another important point is this quick trade what we mentioned, which is like the third possibility, which was, let's say, which is something like this, just for hypothetically targeting the loss here, okay, the take profit target. Now this, if the trade works well, this trade will be in line with the 4-hour bias, because the 4-hour bias is bearish, as I said. So the bias is important. So we showed you three possibilities, three possible trade entries. So first one is, let's say, like a 1 hour to 15-minute trade, which is this trade over here, but you have to wait till the price come here. That's number one. Then it's a bearish entry, which is in line with 4-hour bias. So that probably, if the trade comes here and if it shows signs of going down, it will be high trade. The probability of it being a winning trade will be, odds are high. Number one. Number two is this trade over here, targeting this fair value gap, but that's a counter trend trade compared to the 4-hour bias. So it has to be a quick trade if you are taking that. However, that's also second possibility. The third possibility was, the third possible trade is based on the SMT divergence you see here. Based on that, one could take a quick trade, like we saw it at 8:30. Clearly, we saw the SMT divergence, right? We saw the wicks. However, we skipped that trade. Why? Because we have a checklist, right? Professional traders use a checklist. So the trading team at Traders Oxygen, we have some checklists. One of the checklists is we wait till 9:30 open. So we skip that trade. However, it can also be a winning trade. If the trade was taken at that time, it's currently, the trade was taken, it is currently at a profit of 1 to 2, right? 1 to 2 risk to reward ratio, right? Again, if you are not sure what is 1 to 2 risk to reward ratio, we will subscribe to the channel, click the bell icon. We release videos explaining all those in the very near future. Okay, so this is the pre-market analysis, and hope you enjoyed it. We'll see you in a live analysis to the market, as well as a post-market analysis. Until that, stay safe. And before we leave, I need to tell, we gave you three possibilities. Now, if you ask which one will work, the golden question is which one will work. Okay, this one, or the other one. The answer is we have to wait till what the price tells us, right? When the market starts, we have to see what the price tells us. Okay, when the market starts, if the price tells us, okay, there's entry here, for that there's some sound logic where we go to low level, look at displacement, fair value gap, order block, and then we take a trade. So if the market shows the footprint in any of these locations, it's possible. Then out of this, it's better to take the bearish trades because the 4-hour bias is bearish. So this one or this one would be ideal, but to see this one should, but ideally this one, the one over here, will be the ideal trade. Okay, so hope you enjoyed and stay safe. See you in another video.